Hey guys, David Robinson here. Welcome to the apartment investing journey. Got a special guest on the show today, someone that I've watched since I started to get in the space and started thinking about doing a podcast, and have learned a ton from him, just sort of observing from afar, and really been impressed with his sort of mindset and strategy around marketing in the multifamily space. And so I'm really excited to have John Casmon on the show with us today. John, thanks for spending a few minutes with us.
Absolutely. David, thank you for having me on the show.
So John is a real estate entrepreneur who has partnered with busy professionals to invest in close to $90 million worth of apartment buildings. He is also the host of the Multifamily Insights podcast, where he covers multifamily real estate investing and passive investing. In addition, he is the co-creator of the Midwest Real Estate Networking Summit, a no-pitch event to connect like-minded investors. So, John, very, very brief bio. We here on our podcast love to talk about the journey. And so would love for you to back up and talk to us a little bit about your background and then how this all got started for you.
Yeah, absolutely. First of all, I got to give you a quick shout out too, man. I'm glad you've been able to learn some things from us over the years. But I've also really admired kind of your social media presence. You know, when you launched this show, I was watching some of the graphics you were putting out, and I was like, man, this is beautiful. Like, I got to figure out how this guy is doing this. So I've always had my eye on some of the stuff you're doing as well. So it's great to be talking to you here today. But to give you some background, yes, you kind of alluded to my background's in corporate America in marketing. So I did marketing and advertising for 15 years, working on large brands. I was at General Motors. I worked on Buick, Pontiac, GMC. On the agency side, I've worked on Mountain Dew, Nike, Coors Light, so many other brands. And really, for me, what was important was figuring out, how do I create the lifestyle that I'm looking for? And what I mean by lifestyle, I felt like in most of my career, there was always a lot of pressure, pressure to, when I was at GM, we were going through bankruptcy. So, we kind of had to deliver and perform. When I was on the agency side, well, we had to keep these clients. If we lost that account or our scope of work got reduced, people are going to lose jobs. So I always felt like somebody's job, my job and other people's jobs were always in my hand, right? And I always felt this pressure to perform so people didn't lose their jobs. And I think after a while, it just started to wear down on me. And I just realized, hey, the level of anxiety that I felt was just too much, especially working at a smaller agency. So ultimately, I really started to work my plan as far as building up some passive income, investing in smaller properties. I started off with a 2-unit property. My wife and I, we house hacked. We bought a 2-unit, lived in 1 unit, rented out the other unit. And I still tell everyone, if you are at a stage in your life where you can be a renter, quote unquote, this is the great way to get in and get started. You can use ideal financing. You can take the leverage up. You have some perks for being an owner occupant, and it's a way to ease into property management so you can learn what you do like, what you don't like, start creating kind of the processes and the systems to really build this. If you plan on building a large portfolio, at a minimum, you get to cut your rent in half, right? If you're paying $1,000 in rent and you can rent a unit for $500, $600, $700 and have that mortgage paid for, or at least most of it covered by another resident, if not 2 other residents, that makes it a little bit easier to save money and kind of reach some of the financial goals you have. So I love that strategy. On top of that, we did more. We bought a 3-unit building. We bought an 8-unit building. And then I hit really an impasse because I kept running out of our own money. We would save, buy. And it was at that moment that I really warmed up to this notion of partnering with other people and learn more about apartment syndication and all of those different aspects to really scale a multifamily business.
Love it. And, it's been interesting as I've had a chance to interview, at this point, 100 or more real estate investors that are, very successful. Everyone has their own journey and own path to, how they've how they've gotten to where they are and how they've built up a significant portfolio. But it's not uncommon to hear about people that have great success in real estate, starting with house hacking the very first property, their very first primary residence. And it's such a great strategy. And I think it's less about the financial impact that it has and more mental. I think those people just understand at a very early time in their life the concept of buying cash flow and experiencing appreciation and minimizing their own personal expenses. And it just sets so many people that I've had the opportunity to interview start out that way. And so great to hear about that story of you and your wife house hacking that first duplex. I want to go back a little bit to this transition period from your working corporate job. It's very stressful. You talked about having not the ideal lifestyle that you were hoping for. And I know that we have listeners that are in that phase of life, right? Where they want to make this transition. They're not exactly sure how to go about it. Everybody's story is unique, and I'm sure this will be unique to you, but what guidance could you give for someone who's maybe in that spot in their life, and what did that look like for you? What were the steps that you took to transition from your corporate career to a career in real estate investing?
Well, I think the first thing is you have to make a plan. And you have to understand what success actually looks like, because too often we tie that to monetary numbers, right? Hey, I want to make X amount of dollars, or when I'm making this amount of money passive, I can quit, or whatever the case may be. But you're not necessarily stepping back and saying, what problem am I really trying to solve? And you have to start that process with a clear plan. So you talk about house hacking. Well, you have to back all the way up to, even before I was going through some of these challenges in my first real corporate job. That was always the plan. The plan was always to create a sense of freedom, to have more control over the lifestyle. And the how we do that was the thing I hadn't figured out yet. So we were always trying to figure out what steps we needed to take. How do you live below your means? How do you save to invest as opposed to saving just to save? So that was always the logic and always the approach. And it put us in a position to have those options. So for someone who's in that position today, the first thing I will tell you is sit down, make a plan, understand what you're trying to solve for, understand what success looks like for you, and be willing to sacrifice a little bit to get there. The other part of that is explore multiple options. Just because you hear us talking about maybe, multifamily syndication, don't assume that you've got to go and be a syndicator. You may be great as a passive investor. Maybe that's the way to start. Start getting some passive income. Learn from that standpoint. Maybe invest as, a lender. Maybe do private money. But there are different ways to invest and get some traction in what you're trying to do. Partner with someone else. I think the reason it's so important to understand what you're trying to solve for is you may create more problems. Let me give you an example. When I was in the agency world, I'm working a full-time job. Now I'm married with kids, and I'm trying to grow this real estate portfolio. I ended up doing a couple flip projects on top of the multifamily. So now I've got flip projects going. I've got multifamily. I got 2 kids. I got a pretty demanding and busy job, and I'm stretched pretty thin all over the place. And what ended up happening is I found myself working even harder. And instead of creating this passive income that I was supposed to be doing with real estate, I really created another job. So now I'm over here with 2 jobs running around trying to figure out what contractors is where, and did they get the materials they need? Are they on track to be done by Friday? I'm doing all that stuff while trying to hold down my day job. And by the way, as I mentioned, it was stressful and had high anxiety, and a lot of different things riding on the work we were able to deliver. So there are a lot of different components there. So my anxiety was high, and I didn't have time to work out, didn't have time to eat well, didn't have time to read, didn't have time to take care of myself. Right. So it really made it difficult to see that success. And if I could have stepped back, I would have realized that, hey, you know what, a better path for me at that time would have actually been to be a passive investor, because I didn't really have that kind of free time to invest in the hard work, the labor of being active. But really, that was all I knew. I didn't know anyone who was just taking their money, investing passively. And I wasn't to the point where I felt like I just had money to invest passively. But again, if I could step back and say, hey, what are we really trying to accomplish here? this could have been a much easier path for me. So I would tell anyone, step back, figure out what you're really trying to accomplish, and then think through the different options on the table to help you accomplish that.
Well, and I appreciate you walking through that. Great advice. Getting clear on what that plan is and exploring multiple options before you dive headlong into it, and be careful not to create a new job for yourself that, like you experience a busy career, a dad flipping properties, multifamily, a husband. I mean, my goodness, taking on, you're adding jobs and irons in the fire that you got to handle. Moving forward a little bit, you mentioned, starting out with the duplex, then go into the 3-unit, buying the 8-unit building in this concept of, ultimately saving, buying. And, at some point you're going to run out of money, and it sort of stops there. You made a transition and got into the large commercial multifamily space and in real estate syndication. How did you even learn about that or become exposed to it? And how did you navigate that process?
Yeah, great question. When we bought the 8-unit building, I remember not feeling excited. And every other property I'd ever bought, I was really excited, nervous, but excited after we bought. And with the 8-unit, my initial thought was, now I got to wait to do this again. And I thought about, all the properties that, we would look at and we could do and could make work. But again, I had to wait to save up 6 figures to go, invest in another property. And I just felt like, man, this is not working. It's too slow. I haven't really met the goals that I was shooting for. So we're building up equity, which was great. But I really wanted to insulate myself from job loss as the primary goal. To give context, I was at GM when we went bankrupt. The advertising agency I was at one point went bankrupt. So I was at 2 companies that went bankrupt. Now, I never missed a paycheck. So I think that shows kind of, what I was like in my previous career, but I never missed a paycheck. Even when the agency went bankrupt, the owners paid us to keep us working while they created a new agency and kept continue to move forward. But I say all that to say, I faced these realities, twice in my career where it had nothing to do with me. And it was all about things out of my control where the company went bankrupt, and for one huge organization and one much smaller organization. So when I bought the 8-unit, it was right around the time I think that second company was going bankrupt. And I just remember that I cannot wait around for the cash flow to catch up to the current, lifestyle and expenses. And I had to figure out something else. And that's when I started talking to more people. The notion of working together became more of a plausible option. And I ended up meeting someone who became my mentor, and I hired him as my coach. And he was doing syndications. I never heard of syndications before. I really just wanted to figure out if I could raise, half the money and partner with someone. That's what I was shooting for. And I realized what he was doing and learned more about that and watched him grow. And really that opened up my eyes to the world of syndication. And the next deal we ended up doing was a partnership with another group, and it was 192 units. So I went from doing an 8-unit deal by myself to 192 units with another operator group and working with LP investors. So that really helped me expand. And part of that was the network, being a part of a group and meeting with folks that were in that network. It allowed me to connect with more and more people. And that started to change what I saw as possible because I was no longer limited to the funds that I had in my account. We worked from a place of abundance, and we recognized that, hey, if I could create value, if I can add value here, there's a way we can work together to take down larger deals.
And, we mentioned in the bio that you've acquired over $90 million worth of multifamily real estate with partnering with operators and investors to take those deals down. What does your business look like today, and what do you focus on?
Yeah, we have two arms of the business. And one pillar, it's focused on us kind of playing more of a lead operator role where we find the deals, do everything that you would expect when it comes to that. My primary capacity is more in the investor relations side, marketing, business plan, those kind of things. My partner really oversees more of the asset management, the property manager, construction, those aspects of the deals. And then in the second arm, we do still partner with other operators to find opportunities to help us get some market diversification and find opportunities that we think are right for our investors. So we operate in those two capacities to make sure that we have some deals that are close to us. So we're looking within more of a 2-hour radius, Kentucky, Southwest Ohio to Central Ohio, Indiana. Those kind of markets are really where we're focused more on building the broker relationships and finding those opportunities. But then we'll also love opportunities in Georgia, the Carolinas, markets like that, where we are seeing strong growth, not too far from a geographic standpoint of where we're located, and really just give us a little bit of diversification in the offerings that we can pursue.
And you work a lot with passive investors, LP, limited partners on your deals. What are some of the things that you've learned that really serve the limited partner or the passive investors over the years in the deals that you've done? Is there any takeaways or strategies that you've implemented where you've said, you know what, I've recognized that my limited partners like this? What is that?
I think the big thing is just understanding the place they're coming from. When you talk to limited partners, you understand what they're looking for, what are their objectives. Everyone's different, and don't assume that one investor is going to love the same thing that a different investor loves. Even on the same deal, you can present the same opportunity and maybe both investors like the deal, but they may like it for different reasons. So, ultimately for me, it's not to make assumptions on what someone's motives are, what their objectives are, and really talk to them, understand what they're looking for, understand what they're hoping to solve. And by understanding those things, it empowers you to highlight the right things about an opportunity, and also just to talk to them about it and be able to answer any questions that they may have.
Yeah, love that. That's great advice. Well, look, I wanna shift gears here a little bit, and we from time to time we like to dig into a particular deal that a guest has recently been a part of, and so we want to chat with you a little bit about the Moss Creek deal. If you can, just describe the asset for us, location, asset type, and then we'll go from there.
Yeah, really unique opportunity for us. It's kind of that thing that I really hadn't seen before, and I thought it was really interesting. So this is in Louisville, Kentucky. It's 104 units, 2019 built construction property. So you typically don't see newer properties that are actually B class. So this isn't a high-end luxury apartment complex. It's a very nice, affordable, well delivered property, but it just doesn't have all those super high-end amenities. So we thought that was really intriguing because it plays in that sweet spot where it's still affordable for residents and we can still attract a wide range of potential residents. But we could play in an area where if the economy shifts, some of those Class A residents may come down and really want a property like this because it still is new, it's spacious, the design is fresh, the functionality of it is current based on the kitchen layouts and all those kind of things. So we really like that aspect of it. They're all 2-bed, 2-bath units, all over 1,000 square feet. All of them have washer and dryer hookups in the units. And the thing that was really appealing to us is always the story. We felt like we could create a light to medium value add play here without spending a lot of money on renovations. And that's really appealing, especially in this current environment where material costs are going up. There's a labor shortage that's taking place. And we really want to focus on that NOI as opposed to just construction. So that made it really appealing to us. And as we dug deeper into the opportunity, we saw some things that made us really compelled, and we're able to move forward and close on that deal.
Yeah, love that. And how did you originally source the deal?
Yeah, so this deal was actually marketed, and it's one of those things where it kind of started as more of a pocket opportunity. And I just thought that it was an opportunity where, as we came across it, we were able to come with a different lens to be a bit more creative than I think other folks had. And there are a couple of things that stand out. And I think anytime you're looking at doing a deal in this market, you've got to find some sort of opportunity. And in this case, I don't think they understood the story or told the story in a way that most buyers were looking for. The developer had the property. They actually put new debt on the property right before putting it on the market. And I felt like that really limited the buyer pool. As a matter of fact, even for us, I mean, if we could have put brand new debt on there, this could have been an even more attractive opportunity. They had someone who came in and actually put a full price offer higher than ours, by what, 600,000 more than what we ended up closing on. But they wanted to wipe out the existing loan. And that was just problematic that they put this new debt on there. So for us, we want to find the reason someone else would buy it, but also would not buy it in the current stage. And that really limited the buyer pool by putting on the kind of debt they did. The other thing was they didn't really highlight the value add opportunity. And even when I first looked at it, I almost didn't underwrite it completely because I saw a 2019 Class B property. I'm like, well, what's the value add play here? Why am I going to bother? So sometimes you just have to go through the process and at least understand where that opportunity is. We found comps that justified higher rents. We saw opportunities to create other revenue streams and increase the NOI. And as we stated, there were some things when I did my research on the property, I didn't think they did a good job marketing the project, both for current residents and for tenants, as well as the marketing for buyers. I thought there were some gaps that they missed. To give you a very clear example, they didn't have it listed on apartments.com or some of these major websites. And the pictures they did have out there were of the pre-construction finishes. So they literally didn't have the siding up on the property. You could see I forget what you call it, but the little paper that you put before you put the siding up. That was the picture they had of the property. So it didn't look like it was done or even ready. So a lot of little things like that, where when you dig into it and you see where the numbers are, again, I spent 15 years in marketing, and you understand that part of that demand is by letting people know this thing exists. And I don't think they optimize the ability of getting the word out that this property was there, that it was a brand new property, that, it had these amazing finishes, that it was very spacious, and they just didn't communicate some of those things. So we felt like that was an opportunity for us to come in, take hold of that marketing plan a little bit better and create value that way.
And was this one of the first deals, or maybe the first deal that you've gone in and acquired that didn't have a construction value add business plan, more of a strategic and ancillary, income plan?
Yeah, absolutely. I mean, most of the deals we do, like others, we focus first and foremost on interior renovations, just because that's the easiest way to create value for a property. But that's not the only way to create value. And sometimes you need multiple things to stack up in order to be able to create that value. The other thing with this play is, how do you protect yourself, right? And ultimately, I think there's not enough attention given to how do you protect yourself on a deal. And in this case, we have a property that has 11 years left on the loan. So we're not worried about the loan. We're locked in at a 3.2% interest rate for the next 11 years. So we have a lot of flexibility and control there. On the flip side of that, we came to the table with enough equity that we can add a supplemental loan. So we can always pull some of that out, pay that back to investors, and still hold on to the property. Or if we wanted to sell, another buyer could come in, they can add a supplemental loan, assume our existing loan, and then they can lever up that way. So that gives us some flexibility on the exit and made us feel comfortable assuming the existing loan because we came in with a little bit more cash. Now, I will say the downside of that is our initial return projections are a little bit lighter than what we typically would underwrite, because we are bringing more cash to the table. But we felt it was really important to give ourselves the flexibility of those options, particularly as the market continues to move forward. And we feel like as we start pushing rents to where we can get them and pushing the NOI, that gives us the flexibility to figure out when we want to either, again, add that supplemental loan or start to explore an exit.
Yeah, love that. And just to give us some context, how did you go about structuring the deal?
Yeah, so we did this as a syndication deal. We did a 70-30 split with our investors. We did an 8% preferred return. And, this was one that, like I said, we assumed the existing loan. So that loan gave us a 65% loan to cost. So 70% LTV, loan to value, 65% loan to cost. So we came in with a little bit more equity on this deal to give us the flexibility on, the back end, or if we wanted to do any kind of supplemental loan.
And you mentioned the syndication structure, and was this a 506c?
This was a 506c.
And do you often focus on 506c, or have you focused on 506b, or have you done a blend of the both in the past?
Yeah, we've done mostly B in the past. This was our
Mhm.
first C deal, and we felt that with it being a newer asset, 2019 construction, and we felt the investor base for this might be a little bit different than some of our other value add deals. So that was kind of a strategic move. The other thing was we had another deal that we closed just before this one closed, and we wanted to make sure that we didn't start to make investors pick between the two deals and the two
Mm.
opportunities. So we wanted to have a little bit of differentiation there as well.
And so, with that being your first 506c, that opens up the possibility of marketing this deal on a broader scale than just your personal network that you've built up and spent a lot of time building up over the years. Was there anything that you learned in that process of marketing a deal versus just working with the network that you've already built up?
Yeah, I think there are a couple of things. So for me, the principles of investing never change. When you think about who's looking to invest, typically they want to get to know who you are first and foremost. They want to understand your track record, your experience. They want to know about the market, and then they want to know about the deal and the opportunity, right? So that doesn't change. So if you assume that you're just gonna, slap some marketing dollars on a message and you're going to have all these people running to invest in your deal, I think you'll be sadly mistaken. So they still need to get to know you. There's still a process of, that needs to come through where they're aware of those opportunities. But I will say that it helps to get in front of people who maybe aren't on your list or maybe know who you are and what you do and have the means. So we certainly got investors who saw the opportunity, were very interested in it, reached out, and ultimately move forward with us investing wise, and folks that maybe I wouldn't have reached out to or talked to in the past. So that made it a little bit easier for us to connect with more people.
Yeah, love it. Well, John, I appreciate you, talking to us about your journey. You've given us a lot of, things to consider here, especially, this transition that you made from being in a corporate career and sort of realizing, man, you know what, I'm not necessarily creating the lifestyle that I really wanted to create for myself, and making the pivot into the multifamily space and the real estate investing space, and how you made that transition, and ultimately, how your business is structured today, really focused on syndication and investor relations, both locally doing your own deals as the sponsor of the deal, but also partnering with people in other markets across the country. And so I appreciate you sharing some insights that you have today. I want to start winding down here and be respectful of your time, but a few final questions. The first is, what's the biggest challenge that you faced on your real estate investing journey that we could all learn from?
Overcoming those self-doubt, right? I mean, I think ultimately, I'm a guy who came from corporate America, so I didn't get real estate, right? Quote unquote. I didn't know construction. I didn't grow up with, brokers and in the family and things like that. So I didn't know the real estate piece, and it really held me back. In fact, on some of the flip projects we did, we lost money because we gave our trust to people who were real estate people, the contractors, the developers. We kind of trusted that they knew more than us because they had that experience. But I put in a lot of work. I read a lot of books. I've attended a ton of events. I listened to a lot of podcasts. I've networked with a lot of people. And from having all of those conversations, you develop some best practices, even though you may not have actually done the work yourself. And then you compare that to someone else who maybe they've done more deals than you, but maybe they haven't invested in the education as much as you. So the big lesson for me was to trust the work you put in, trust the process, trust the knowledge that you've gained. And even if you come across someone who has more experience than you, just because they have more experience doesn't mean that they're going to be right. So trust the work, trust the process, and always listen to your gut.
Well, and this may be what you just provided may be the answer to this next question, but what's the best advice you have for someone who's just starting their apartment investing journey?
Yeah, I think one of the things that's really important when you start this journey is to find some wins. You can sit there and analyze deals all day long and never actually progress forward. So find a path of least resistance. If you can partner with others, if you can join a team, if you can be a limited partner, find a way to get some real traction so you can continue to your learning process, you can continue the growth process, and understand that this is a team sport. And what that means is you are going to find more success by working with other people than trying to do it all by yourself. So if your plan right now is to reach out to brokers and find deals and analyze these deals and put in your offers by yourself and get all the money together by yourself and manage the properties by yourself, it's going to be a nightmare. So find a team, find a mentor, find a coach, find partners, find people that can help you get real traction in your journey. And that's going to make it much easier for you to see success.
Yeah, great advice. Well, look, John, again, I appreciate your time, appreciate you coming on. It's been an honor to have you on the show since, you're someone that I was looking to sort of guide the direction that I wanted to take this side of the business for me. And I just appreciate your time and sharing some insights with our listeners. What's the best way for our listeners to connect with you and learn more about what you have going on and potentially even participate in a future opportunity you may have?
Yeah, I think the easiest thing is we've got a sample deal on our website. And whether you want to be an active investor and want to figure out what kind of information to put into an offering that you may have, or you want to be passive or just learn more about the lingo and kind of, the deal structure and things like that, it's a great resource just to get more familiar with it. As a follow-up, we actually send the top 7 questions or the top 7 things you need to be looking for when you evaluate an opportunity. So that's a free thing you can download, but great value. You can check that out at casmoncapital.com/sample deal. And from there, you'll get emails and more things to follow up with the podcast and all that stuff. But I would start with getting that sample deal.
I love it. We'll have that link in the show notes. If you want to grab that sample deal package and connect with John and his team, go click on that link in the show notes right now. Again, John, an honor to have you on the show. Thank you for sharing your time with us, and I look forward to connecting with you again soon.
David, thank you for having me, man. It's been a great pleasure. I'm glad to see you doing so much great things here and having all this success.